Buying an existing profitable business is a great way to get into a business for yourself without having to start from scratch. And SBA loans are the preferred financing vehicle to get you there. But the SBA requires a minimum down payment of 10%. Hey, I'm Ray Drew, an actual SBA lender, and in this video, I'm going to break down the idea of buying your own business with other people's money. Like I said in the intro, the SBA will allow lenders to finance up to 90% of a business acquisition, leaving the borrower to inject a minimum of 10%. And the SBA allows the seller to contribute up to half of the required injection. The way they allow this is by having the seller hold a note for 5% and placing that note on full standby for the life of the SBA loan, meaning the seller cannot accept any payments for the duration of the SBA loan, which is likely going to be 10 years. That leaves you with 5% as the buyer. And if the sell note isn't an option, then you're going to just put in the whole 10% cash yourself. Now that 10% can be from investors or a gift from friends and family. Now the SBA does require the funds to be seasoned in a bank account for 2 full bank statement cycles, which your investors or gifters can provide, or they can give you that money now and you can just season it in your bank account for the next 2 months. Couple things to note though. One, investors are probably going to want to own less than 20% of the business so that they don't have to personally guarantee the loan. And if it's a gift, then they will need to provide a gift letter. So under this structure, you'd be able to buy a profitable, cash flowing from day one business without any of your own money. And in the intro, I said I'm going to break down that idea. And I really hope you're still watching because this is likely not possible. If I'm a lender, and I am, there's no way I'm gonna lend to someone with no skin in the game. So while technically it's an eligible structure, it's like chasing a rainbow. And do I look like a leprechaun? Don't answer that. So let's get real about how to actually structure an SBA business acquisition loan. First of all, the minimum equity injection is 10%. Like I said, that's true. But not every lender is cool with just the minimum, and most take a deal by deal. But assuming that it's going to be 10%, as a lender, I'm going to want at least half of that coming from your own personal resources. As the person signing the note, the rest can come from investors or friends and family, gifts, etc. And then the remaining of the financing can be an SBA loan. However, what I see more commonly is that buyers will have the seller hold a note for, let's say, about 10%, so that they have some skin in the game as well. Many lenders will also want to see that. It just helps ensure full transparency from the seller and a smooth transition. The 80-10-10 structure is the most common one I see, and most buyers will just inject the 10% themselves. So let's say you have $1 million business acquisition, those buyers are usually going to have about $150,000 liquid for themselves so that they have enough for the injection plus a little bit of post-close liquidity for cushion. So start saving up. So there you have it. If you found that video helpful and you want more insider tips from an actual SBA lender, I would invite you to click that subscribe button because I've got plenty more where that came from.